Welcome and thank you for joining today's Department of Market Monitoring 2024 Q3 Market Issues and Performance Report public call. Please note that all audio connections are currently in listen-only mode. To indicate that you wish to ask a question, click the raised hand icon located on the bottom right of the participant panel. If you are not logged into WebEx and instead dialing in, you can press *3 and that will place you in the question queue. If you require any technical assistance, please send a chat to the host. With that, I'll turn the conference over to Ryan Kurlinski. Please go ahead.
Thanks, Ahmed. Can you hear me?
Yes, I'm able to hear you.
All right, and this is being recorded?
This is being recorded.
Fantastic. Okay. So hey, I'm Ryan Kurlinski, manager in the Department of Market Monitoring, and today I'll be going over some highlights from our third quarter 2024 report on market issues and performance that we published last month. So yeah, the report and the analysis in these slides are the work of all 17 people in the Department of Market Monitoring. I'm just the person that gets to present them. I change slides. All right. So, it looks like I lost what I'm sharing here. 1 second. I mean, you're seeing the gas prices down slide?
I am seeing the first slide, the title page.
Ooh, okay, that's not good. Yes, I'm not able to control the slides. 1 second. Looks like it looks like I need to take control of sharing. Huh?
It seems that the screen share has been disabled, so if you could reshare. Here you go.
Yeah.
There you go. Now we can see it.
Excellent. One last setup here. All right.
We can now see the gas price.
Perfect. All right, thank you. I think we're ready to go here. Excellent. All right, so this chart is showing monthly average natural gas prices at the Henry Hub, which serves as a national reference point for gas prices around the country, as well as major gas hubs around the West. Gas prices were down significantly in the third quarter of 2024 compared to the third quarter of 2023. The Henry Hub price was down 19% from the third quarter of 2023. But prices for the major delivery points in the West decreased even more substantially when compared to a year ago. PG&E Citygate was down 37%. Gas prices at SoCal Citygate were down 58%. Northwest Suma's prices were down 60%. And El Paso Permian gas prices were down 104%. You can see there, especially July, August, September, the green line. El Paso Permian gas prices were negative on average over the quarter due to pretty low negative prices there on average for the month of August. So this chart is showing weighted average 15-minute market electricity prices, monthly electricity prices for different WEIM regions since from January 2023 through the end of the third quarter of 2024. What we're seeing here is that the lower gas prices we saw on the last slide brought electricity prices down with them. 15-minute market prices across the WEIM averaged about $40 per megawatt hour. That was down about 31% compared to the third quarter of 2023, despite higher loads. We'll talk about loads later on in this talk. In this quarter, California recorded the highest average price. So WM balancing areas within California, reported the highest average price at about $47.50 per megawatt hour. While other regions, average prices in the 15-minute market ranged between $33 per megawatt hour and $38 per megawatt hour. The greenhouse gas costs in California contributed significantly to the higher prices in California WEIM balancing areas compared to balancing areas in other regions. So this chart is showing for the third quarter of 2024, each balancing area's average 15-minute market prices. So that's the blue line showing the overall LMP, average LMP for each balancing area for the quarter. And then the bars show how each balancing area's average LMP is broken out by price component. So what we're seeing here is that the green bars, right, that the GHG costs for power in California were the main contributor on average across all hours and all days in the quarter. The GHG costs in California were the main contributor to elevating prices in California balancing areas relative to other WEIM balancing areas. Let's see, we also see some significant congestion on WEIM transfer constraints into PowerX and BPA that increase their prices relative to other non-California balancing areas. And then looking at the yellow bars, there's also congestion from flow-based internal congestion constraints, on average, decreasing prices in the Pacific Northwest relative to Northern California. That was largely from north to south congestion on COI nomograms, the California-Oregon interface nomograms during evening peak hours. All right, so now we're looking at the 15-minute market prices by hour for these different regions in the WEIM. And here we see that the California greenhouse gas costs weren't the entire story of price separation between the regions, right, when you're looking at this hourly. During midday solar hours, there was transmission and transfer constraint congestion from Southern California, desert Southwest areas, and Intermountain West areas into the Pacific Northwest and Northern California. But then this transmission congestion was then largely offset by congestion in the other direction from north to south during the evening peak net load hours. Also to note here, so during hour ending 20, California regions weighted average 15-minute market prices averaged about $120 per megawatt hour, and desert Southwest and Intermountain West prices averaged around $90 and $80 per megawatt hour respectively, while prices in the Pacific Northwest were around $45 per megawatt hour. So now we're looking at the same chart, but this is weighted average hourly prices from the 5-minute market in the WEIM for the third quarter of 2024. We see this similar kind of pattern, pricing pattern that we see in the 15-minute market. But do note that from hourly 19 to 21, those average hourly prices in the 5-minute market in the desert Southwest, Intermountain West, and California regions were significantly lower than the 15-minute market prices we saw for those evening peak load hours on the previous slide. Particularly during hourly 20, prices in these regions in the 5-minute market were $30 to $50 per megawatt hour lower than average 15-minute market prices. Do a couple more slides here, then I'll stop for questions. So this slide, the focus of this slide is about comparing day-ahead regional prices to 15-minute market prices. In particular, the solid navy line shows the monthly average bilateral day-ahead prices at the Mid-Columbia Electricity Trading Hub. That's the peak, their day-ahead monthly average peak product prices. So those are hours 7 to 22 for all days except for Sundays and holidays. That's that solid navy line. And the bilateral prices at mid-C. And the main point of the slide is to compare that to the dashed navy line. That instead shows the ISO's 15, the weighted average 15-minute market prices in WEM balancing areas in the Pacific Northwest. So looking in particular for July through September of 2024, we see that those bilateral mid-C day-ahead prices are significantly higher than the WEIM 15-minute market prices in the Pacific Northwest. And then also in this slide, we include, for comparison, the weighted average day-ahead market prices from the ISO markets at the Pacific Gas and Electric load node. That's the solid light blue line. And then we can compare that to the dashed blue line, which is the WEIM 15-minute market price at that Pacific Gas and Electric load node. So we note here that the convergence between the ISO market, PG&E, the ISO market day-ahead and 50-minute market prices, those prices are significantly converge significantly better. Right, but the day-ahead and 50-minute market prices at the PG&E node converge significantly better than the prices between the day-ahead bilateral price in mid-C compared to the Pacific Northwest 15-minute market prices. And that's particularly true here for the third quarter, July to September, but it's also true particularly for mid-C as you look at over the last year and 3 quarters or so. This is the same chart here, but instead of looking at mid-C, we're the solid red line is the monthly average prices of the bilateral day-ahead ICE peak product price at the Palo Verde Electricity Trading Hub, and the dashed red line is used as a comparison, and that dashed red line is the weighted average 15-minute market price for load in the desert Southwest WEM balancing areas. And again, we see that there is, especially in the third quarter of 2024, July through September, that those bilateral prices there at Palo Verde are significantly higher than the WEM 50-minute market prices in the desert Southwest. Not higher to the same extent as those mid-C prices were higher than Pacific Northwest prices, but still significantly higher. And again, we're throwing in here, we put in the Southern California Edison prices, the day-ahead ISO prices at SCE is the solid yellow line, and the dashed yellow line is the 50-minute market prices in SCE. And we see that those 50-minute market prices in SCE converge better to the ISO day price at SCE than those bilateral prices do converge to the kind of equivalent 50-minute market price in the desert Southwest. All right, with that, let's stop for questions. Does anybody have any questions at this point? Yeah, can you hear me?
Yeah. As a reminder, pressing *3 will place you in the question queue. If you have dialed in, if you are a participant of WebEx, you can click the raise hand icon located on the bottom right of the participant panel. So we do not currently have raised hands, but we do have questions in the chat.
Okay. Yeah, can you read those to me? I'm not able to see that, sorry.
We have one question from Eric Zhu. Why is the 5 minutes price lower than the 15 minutes?
That's a good one, and I will get to that this next slide, and then when I get then actually about 5 or 6 slides after that. So good question. We'll get to that in a second. Any other questions?
There was just, could someone please share the link for the presentation slides?
Oh, okay. Yeah, those slides have not been posted publicly yet, but they will be shortly, within a day or two after this presentation, hopefully. But all these charts are in the publicly posted report on the DMM website.
All right, there are currently no additional questions.
Great, thank you. I'll keep moving then. Okay, so to compare hourly day-ahead prices to hourly real-time prices, we obviously have to look at the prices in the ISO markets, as those bilateral markets don't have hourly prices. So for this chart, we're just looking at prices in the ISO markets, and for the three markets in the ISO markets, the day-ahead 50-minute market and a 5-minute market, and just for the CAISO balancing area, that is the only balancing area currently in the ISO day-ahead markets. And also on this graph, the dashed red line shows the CAISO balancing area's hourly average net load. Of note in this chart is that the hourly shape of prices in the ISO markets continues to follow the shape of net load, where we get peaks in the morning hours when net load has a peak there, and also we get price peaks. We get lower prices during the midday solar hours, and we get some price peaks during the evening peak net load hours. Also of note here is that the day-ahead market prices, that's the blue line, converge pretty well with the 15-minute market prices, that's the yellow line, and that's by design. Convergence bidding is designed to converge day-ahead market prices to 15-minute market prices. But during these peak evening net load hours, we see significant, we see that 15-minute market price being significantly higher than the 5-minute market price. And we'll talk about that in a few slides. This graph is showing the hourly average 5-minute market load forecast load by region for the third quarter of 2024. That's the stacked colored bars there. Each region's average hourly 5-minute load for the third quarter of 2024. We also have the dotted black line that shows the hourly average system load for the third quarter of 2023. We see that system load is up about 4% overall in the third quarter of 2024 compared to 2023. And as noted earlier, prices across the WEIM were lower despite these higher loads. That was due to the lower natural gas prices. Average CAISO balancing area load for the quarter was about 29 gigawatts. Desert Southwest average load was about 22 gigawatts. Pacific Northwest average load was also about 22 gigawatts, while load in the Intermountain West was around 11 gigawatts, and the non-CAISO California load averaged about 6 gigawatts. All right, so this table, the left side of the table, shows each region's and each balancing area's the day and the quantity of that region or balancing area's peak load during the third quarter of 2024. And then the right-hand side shows each region's and balancing area's load during the overall WEIM system peak, which occurred on July 10th, hour and 18, interval 11. The WEIM system load, system peak load was 135.3 gigawatts at that time. This was higher than the 2023 peak WEIM system load, which was 131.6 gigawatts. We see on the left-hand side that most balancing areas in the WEIM had their peak loads for the quarter on days other than July 10th, right, on days other than that system peak. And that each BA's peak load for the quarter was less than its load during the WEIN system peak on July 10th. While the system peak load was about 135 gigawatts, this was significantly less than the sum of each individual balancing area's peak loads. But the sum of each individual balancing area's peak loads for the quarter added up to 146 gigawatts. This 11 gigawatt difference is one way of describing the benefit of multiple balancing areas with peak loads occurring on different days and times, all being in one market. All right, so here we are looking at the average hourly load adjustments that balancing areas in the desert Southwest and California make to their load forecast in the 15-minute market on the left and in the 5-minute market on the right. This is for the third quarter of 2024. The adjustments are shown as a percentage of the area's average load over the quarter. So it's a percentage of each area's average load. Just get a perspective of how large, relatively how large each area's manual load adjustments are. So we see that balancing areas besides the CAISO balancing area do make significant adjustments to the load forecast, especially in the 5-minute market. However, the CAISO balancing area does stand out for its large load adjustments over the peak net load hours in the 15-minute market, that lower left quadrant there. The CAISO BA's load adjustments for hour ending 18 to 21. So in the 15-minute market, their load adjustments for those hours were an average about 2,000 megawatts larger than the load adjustments in the 5-minute market. So to answer the question asked previously, this difference in the load adjustment, 2,000 megawatt difference in the load adjustment between the 15-minute market and 5-minute market, that contributed to those 15-minute market prices being higher than 5-minute market prices on average over those evening peak net load hours in California, the desert Southwest, and the Intermountain West. All right, and this is a good time to stop for questions, as I'm going to move on to some supply conditions. I mean, I've talked about prices and load conditions. So, can we stop for another question break here?
As a reminder, pressing *3 if you've called in will place you in the question queue. If you have joined as a WebEx participant, you can click the raised hand icon located on the bottom right of the participant panel. Well, we do not currently have any raised hands and no additional questions in the chat.
All right, keep on moving then. All right, so now let's look at changes in supply in the various WEIM regions from the third quarter of 2023 to the third quarter of 2024. Positive values here show an increase in the fuel type compared to Q3 2023, while negative values show a decrease in the fuel type. The black line shows the hourly average increase or decrease in load. Here we're looking at changes in fuel type year over year for the desert Southwest. In the desert Southwest, we see an increase in load met by an increase in natural gas and solar in the morning and midday hours. An increase in solar production fuels an increase in battery charging midday. And the solar also displaces net imports into the desert Southwest. In the evening peak net load hours, the increased battery and hybrid resource discharge that contributes to meeting the increased load. Now we're looking at the same chart, but for WEIM balancing areas in California. In California balancing areas, net imports from non-WEIM areas, that's the dark red bars, those net imports from non-WEIM areas were up across all hours compared to the prior year. But that was at least partially offset during most hours by a decrease in net imports and transfers in from WEIM balancing areas. That's the lighter red bars. Similar to the desert Southwest, increases in solar and hybrid production during solar hours fuels the increase in battery charging. We see natural gas production was down during most of the day, and a large increase in battery discharge during peak net load and evening hours helped to supply the increase in load. All right. Now, for me, this is actually the most interesting chart in the report. So the Intermountain West region saw a large year-over-year reduction in coal generation. And my understanding from the analysts and DMM who looked into this is that was due to existing coal units being changed to be natural gas units. So we see that this coal was offset across all hours by increased natural gas generation and imports and transfers in from WEIM balancing areas. And increased solar production made up for some of that decrease in coal instead of going to natural gas during the midday solar hours as well. And then finally, it's the same chart before the Pacific Northwest region. The major story in the Pacific Northwest was a large increase in hydro production compared to the third quarter of 2023. This met the load increase in the region and resulted in a large decrease in net imports into the Pacific Northwest from non-WEIM balancing areas over all hours on average. And that ended up resulting in the Pacific Northwest being a net exporter on average in each of the 24 hours in the third quarter of 2024. So we thought it'd be interesting to show an analysis of the supply stack during a 15-minute market interval on one of the highest load days of the year for the WEIM system. So the next two slides we'll look at, it shows supply and demand in the 15-minute market for the whole WEIM system for 6:15 p.m. on September 6, 2024. There was no transfer. There was no WEIM transfer constraint congestion during this interval, and there's very little congestion on internal transmission as well. So we thought it was a pretty good interval to look at, for looking at how the WEIM system load clears against the WEIM system supply stack. So this graph shows bids by generation fuel type. On the left-hand side, right, the negative $250 bids, those represent resource minimum operating levels. The next step up is negative $200 bids. That represents self-schedule resources that don't put in economic bids, but self-schedules above a resource's minimum operating levels. Note here that much of that minimum operating capacity is natural gas, a little bit of coal and hydro. And much of the self-schedules, they're at negative 200. A lot of those are hydro and imports. A large portion of the supply that meets, and we'll see in the next couple slides from here, that the load on this day was around 155,000 megawatts. It's noteworthy that a large portion of the supply that meets that 155,000 megawatt of system load comes from minimum load energy and self-schedules. And let's see, next slide, we'll zoom into the economically bid portion of the supply stack there, more to the right there. Yeah, so again, it's the same chart, but just, I think it's from about 110,000 megawatts up. And it shows all of the resource bids that were bid in economically. So from this, takeaways are that much of the supply bid in at or below $0 per megawatt hour. That's from wind, solar, and hydro. About half the supply bid in the range from $0 to $100 per megawatt hours from gas resources. The other half of the supply from $0 to $100 is mostly made up of battery, coal, and hydro. The upper end of the supply stack from $100 to $1,000 per megawatt hour is mostly battery and hydro resources, but there are some gas resource bids in that range as well. All right, so this graph shows the upper end of that same supply stack. That's the red line. It adds a demand curve for this interval, which includes the demand forecast for this 15-minute market interval and losses. And so that goes up to about 155,000 megawatts. And the economically bid demand, the downward sloping part of the demand, is mainly batteries and hybrid resources. During this interval, the intersection of the supply and demand curves are just about equal to the system marginal energy price that the software produced of about $63 per megawatt hour. So again, we thought it was a good example interval to kind of go through this exercise. The graph also adds a representation of a cost-based supply curve. It's the yellow dotted line. That's the minimum of each resource's bid and its default energy bid. Default energy bids an estimate of the resource's marginal cost. We see that bids were relatively close to cost through the megawatt level at which the system cleared during this interval. So substituting cost-based bids for bids submitted by resources would not have had a large impact on the energy price during this interval. However, you look further up the bid stack, resources, right, the resource bids, the red line, the resources are bidding significantly above cost-based bid levels as you get to higher megawatt load levels. So at higher load levels, the system is not as competitive, and so resources bidding above cost could significantly increase market clearing prices above competitive levels for higher system load levels. Let's stop again for questions on that.
We do have one question in the chat. You mentioned about CAISO net import from non-WEIM area increased. Did I hear that correctly? By any chance, do you know where those imports are coming from?
CAISO imports. Well, I don't know exactly if I talked about CAISO. I think it's so California. Go back to the California slide. Yeah, so these dark red bars, yeah, those are the imports from non-WEIM areas. I've not analyzed which balancing areas those may have been coming from. But yeah, that is correct though. That our data does show that's what those red bars are. They're showing an increase in imports each hour from non-WEIM balancing areas. Any other questions for now?
There are currently no raised hands and no additional chat questions.
Right then, let's talk about assistance energy transfers. Assistance energy transfers, that's an optional program that WEIM entities can opt into on I think it's a daily basis. If not opted in, when an area fails a resource efficiency test, the area's transfers in are limited to what the area had transferred in during the previous interval. If an area is opted into assistance energy transfers, they can receive transfers that are in excess of that, of whatever those transfers were in the last interval. So let's see, during the third quarter, 10 WEIM entities opted into assistance energy transfers for at least one day. This table is showing some data on them. We see 7 of these entities received WEIM transfers in excess of what they would have received if they had not opted in. And then let's see, Public Service Company of New Mexico received the most additional megawatt hours of assistance energy transfers in the third quarter. They received 973 megawatt hours over 79 intervals in which that balancing area failed the resource efficiency evaluation. And the largest additional amount of power it received in any interval as a result of opting in was 434 megawatts. All right. This graph shows quarterly congestion revenue right auction revenues received by transmission ratepayers. That's the blue bars for each quarter. And then it also shows the payments made to those auction congestion revenue rights based on day-ahead market congestion rents. That's the green bars. When auction revenues received by ratepayers are less than the payments made out to those auction CRRs, sorry, when the blue bar is less than the green bar for a quarter, transmission ratepayers lose money from the congestion revenue right auction process. And those net losses are shown by the gold line. So here in Q3 2024, transmission ratepayers actually made about $2 million overall from the auction process. And that's the first time ratepayers have made money in the auction on a quarterly basis since the third quarter of 2016. DMM estimates that load serving entities made about $14 million from their actively trading in this CRR auction, and so you know their active trades actually offset losses incurred from the auction design. This auction design, which forces transmission ratepayers to essentially auction off other CRRs based on the transmission system at a $0 reservation price. Last quarter, DMM put out a white paper on an auction design that would not include the sale of a large number of congestion revenue rights offered at a $0 reservation price on behalf of transmission ratepayers. But went over a design that would instead only have congestion revenue rights for sale that were willingly offered by load serving entities, financial entities, and others at a reservation price that they were comfortable offering at. All right, so this graph shows real-time imbalance offsets for WEIM areas that are only participating in the real-time market. Those real-time balance offsets for these real-time WEIM areas were a $28 million credit to entities in the third quarter of 2024, and that's down from a $115 million credit in the third quarter of 2023. The congestion portion of the offset, you see that's the green bars. That was a $31 million credit to WEIM entities, and that's largely from congestion rent from WEIM transfer constraints. The other bars, the light blue and yellow, that's the energy and loss portions of the offset that combined to be a $3 million charge to WEIM entities. So now this graph shows real-time imbalance offsets for areas participating in the day-ahead market, which again currently is just the CAISO balancing area. And it's a very different dynamic. Those real-time imbalance offsets is a very different dynamic for balancing areas to participate in the day-ahead market. The congestion portion of these offsets, that's the green bars, those are mainly uplift costs that must be paid by measured demand due to transmission limits in the real-time markets, oftentimes being put lower than transmission limits used in the day-ahead market, and that's often to deal with loop flows in real time. So these real-time balance offset costs for the CAISO balancing area for the quarter were $78 million, and that's a cost and uplift charge to mainly to load serving entities and exports. And that's down from $106 million charged from the third quarter of 2023. The congestion portion of the uplift costs, in those light green bars, that was about $48 million, while the energy portion of the uplift costs were around $29 million in the third quarter of 2024. All right. So the CAISO balancing area uses adjustments to the residual unit commitment load forecast to procure extra capacity to cover uncertainty between what the day-ahead net load forecast is and what the actual net load may end up being. The CAISO balancing area looks at system conditions to determine if it thinks it needs capacity to cover no uncertainty, the 25th percentile of potential realized uncertainty, the 50th to 75th percentile of uncertainty, or the 97.5th percentile of uncertainty in the day-ahead net load forecast that might materialize by real time. So this graph shows the average residual unit commitment load adjustment that the CAISO made each day over the peak morning and evening hours from May 7th through the end of the third quarter of 2024, so September 30th, 2024. The color coding shows our DMM estimate of which percentile of uncertainty the adjustment was intended to try to cover. And so we have a shadow system that we kind of recreate the mosaic quantile regression here to We use that to try to estimate which percentile of uncertainty we think these adjustments were meant to try to cover. During the third quarter, 2024, CAISO attempted to procure capacity to cover the 97.5th percentile of potential net load uncertainty on only 15% of days. Those are the red bars, the days of the red bars. CAISO targeted the 75th percentile on 51% of days, that's the yellow bars, and the 50th percentile on 34% of days, the green bars. Again, that's for the third quarter. Obviously, for the May 7th to the end of June, it was all 50th percentile or no adjustment at all. So the percentile of uncertainty that CAISO is aiming to cover with the RUC adjustment has implications for the extended day-ahead market's imbalanced reserve product demand curve. That's because the RUC adjustment is meant to procure capacity to cover just about the same net load uncertainty as the imbalanced reserve product is intended to cover. But the imbalanced reserve product demand curve is designed to pay $25 per megawatt hour to get capacity to cover that 97.5th percentile of uncertainty in all hours of all days. And as you can see from CAISO's use of the RUC adjustment in the third quarter, CAISO rarely needs to procure capacity to cover the 97.5th percentile of uncertainty. On most hours and most days, CAISO seems to be comfortable relying on capacity that does not have an ISM RUC award to show up in real time to meet most net load uncertainty that may materialize. The current use of the RUC adjustment indicates that the imbalanced reserve up demand curve will be too high during most hours. Right? It's designed to pay $25 per megawatt hour for the last bit of capacity to cover the 97.5th percentile of uncertainty all hours of all days. So that imbalanced reserve up demand curve, the way it's currently designed, it's equivalent to the ISO setting the RUC adjustment at these red bar levels that we see in this graph for all hours of all days. And that's clearly not the actual demand for extra capacity that the day-ahead market needs to procure during most hours. So DVM continues to recommend that the ISO try to more precisely define when and how much it can count on capacity that does not get day-ahead market awards. Now, how much can it count on this other capacity to show up to meet uncertainty that might materialize in real time? And we think that could help the ISO to significantly reduce the imbalanced reserve product demand curve and make it more accurately reflect the demand for capacity that's needed to cover uncertainty during most hours. Okay, let's see, just have one more section, cover priority wheel through, so let's stop again for questions.
We do have a couple of questions in the chat. Can you say whether the RSC failures were more caused by capacity failures or flex failures?
Without having the data right in front of me, just my recollection from looking at these markets day in, day out, yeah, more of the failures, I believe, were from the flexible failures.
On slide 22, what does the DMM believe is causing the reduction in RTCIO credits from 2023 to 2024?
Likely lower congestion on less congestion on transfer constraints. We did see overall more congestion in the third quarter of 2023, I believe, than we did in 2024. That would contribute to that. And then lower prices as well. Having lower prices in 2024 would tend to have lower price differences during high price days as well. So that would also tend to reduce, but it would also be a contributing factor to reducing congestion around some of those WM transfer constraints.
We have another question. What was the reason why ratepayers actually earned money in 2024 Q3 since 2016? Grid conditions or something else? On slide 21.
Yeah, I mean, there's a lot of factors that go into whether or not the auction revenues are going to be less than the payouts to CRRs. We estimate how much load-serving entities, which mainly the transmission ratepayers who bear the losses or profits from the auction. We estimate how much they made from their own activity in the auction. And so for this quarter, we do estimate that load-serving entities, due to their trading, that they made I think about $14 million from actively trading. So they were successful in their active trades during this quarter. So given that, given the overall profits were $2 million, the auction design, which currently uses an estimate of what the transmission system is going to be, and then how much transmission the estimate is there after allocated CRRs, and they use that to auction off additional CRRs on behalf of ratepayers at a $0 reservation price. We do think that in this Q3 that transmission ratepayers did still lose money from that aspect of the auction design, but it was just offset by successful trading activity in the auction from load-serving entities from their active trading. But also, again, like we talked about the last question too, maybe I probably should have put some numbers up here for the change in congestion, but there was overall lower congestion rents in the Q3 2024 compared to Q3 2023, right? So that would also play a role. Lower congestion rents, right? So when the CR auction occurs, people may place their auction bids based on what they expect congestion to be. If lower congestion materializes, then there's going to be less payouts on those CRRs that were procured in the auction. So yeah, there was lower congestion in this quarter, which also contributed to there not being as many losses for transmission ratepayers on the auctioned CRRs that other entities had bought. Any other questions?
There are currently no other questions.
All right. Last section here on priority wheel-through reservations. In January 2024, the CAISO balancing area began its new process for awarding priority wheel-through capacity reservations. These would have the same priority, scheduling priority as CAISO native load. Those reservations began in June 2024. This table shows the priority wheel-through reservations sourced at each intertie for the months of June through September 2024. We can see that most of the reservations were at Knob and Round Mountain 230, and then there were some additional reservations at Malin in June, July, and August. But yeah, Malin didn't have any reservations for September. All right, so this graph shows various capacity components that go into determining how much capacity is available for priority wheel-through reservations at the Knob intertie for these 4 months. Note here that this graph, it shows the final values for each month, not the values that may have been used in earlier reservation windows to determine how much capacity CAISO would make available for wheel-throughs when it came to the month. So in priority wheel-through reservation windows prior to final resource adequacy showings, the CAISO has to estimate how much capacity at each intertie to make available for priority wheel-through reservations. They start with the available capacity, transmission capacity on the intertie. That's the red line. And that's the total transmission capacity on the intertie minus expected outages and minus existing transmission contracts and transmission ownership rights, ETCs, TORs. So then to determine how much capacity is available for priority wheel-throughs, they then further subtract off an estimate of native load needs. And that's based on the past 2 years of resource adequacy imports at the intertie and also load-serving entity contracts to supply load at the intertie that may not be resource adequacy. So that native load needs, that's the green bars. And then the ISO then also subtracts off a transmission reliability margin, that's the yellow bars. And that the transmission reliability margin It accounts for uncertainty in native load needs and transmission outages. Because obviously when the ISO is trying to estimate how much capacity is available to give out reservations in earlier reservation windows, they don't know exactly what the outages are going to be. They don't know exactly what the native load is going to be. So they do this yellow bar, the transmission reliability margin, to account for uncertainty in native load needs and transmission outages when they're trying to figure out how much capacity to make available for priority wheel-throughs. So then what's left can be reserved by those priority wheel-throughs. The turquoise bars, that's the capacity reserved by these priority wheel-throughs, and the gray bars, it's the capacity left over. It's left over after this process that weren't reserved, and that's then left over for reservations that can be made in the daily time horizon. So the focus here is September, the month of September on the right-hand side. In an earlier reservation window, for the reservations there at Knob for September, the CAISO balancing area underestimated native load needs. So it made more capacity available for priority wheel-throughs than the intertie could handle if all resource adequacy imports and priority wheel-through reservations self-scheduled at the same time during the peak hours when a lot of these reservations were made for. So what we see here is the sum of the final native load needs, that's the green bar, and the final priority wheel-through reservations of the turquoise bar that exceeded the transmission capacity that actually ended up being available on Knob in September. The last slide. So this just shows the native load need estimates on the left for each month, and then the final values for native load needs for the Knob intertie. The ISO estimated native load needs would be about 797 megawatts in July, 956 megawatts in August, and these are the estimates, and 1,260 megawatts in September. Those are the stacked blue, yellow, gray bars. But this underestimated actual native load needs at Knob by about 357 megawatts in July, or 31%. Underestimated those native load needs at Knob by 17% in August, and underestimated the native load needs at Knob by about 299 megawatts, or 21% in September. So that oversubscription we saw in the previous slide for September, right? It was this underestimation of native load needs for September that resulted in the CAISO making more capacity available on Knob for priority wheel-through capacity in an early reservation window than Knob could actually ultimately accommodate, given the transmission capacity that was available, and the resource adequacy import showings ended up coming through there for September. And that is all I have for today. We can take some final questions, but yeah, let's see if there's any final questions here.
As a reminder, if you have dialed into WebEx, you can press *3 and that will place you in the question queue. If you have joined as a participant, you can click the raised hand icon located on the bottom right corner of the participant panel. We do have questions in the chat. Were the buyers of the LSE auctioned CRR's generators, i.e. hedgers of congestion exposure versus financial entities?
Yeah, so I haven't dug. I personally have not dug into exactly what was going on in the third quarter in terms of by entity, but historically our analysis has shown, yeah, that most of the purchasers of CRRs in general are the largest quantity goes to financial entities. But in terms of I guess the specific question there was it about the CRRs sold by load serving entities in this quarter where they bought by financial entities? I don't know. We would have to do some more analysis on that to look at specifically who load serving entities when they made this money in the third quarter, who they were transacting with. It's not a straight. The thing with the auction design, it's not a straight transaction either. So it's difficult to tell, right? You can't. There's not just a single buyer. It's a whole network approach. So it's not. You can't directly tell who's buying an offer that LSE may have made. but we could. I think in the annual report we do compile up, who the buyers were over all of CRRs, who the sellers were over all of CRRs. Any other questions?
There are currently no other questions.
Okay, so I want to thank everyone for listening in today. I really want to encourage people, if you have questions, please reach out to us. We have all kinds of reports and comments on stakeholder initiatives on our GMM webpage. We love meeting with people, chatting with people if they have questions. We can set up meetings to talk if people have other questions about these reports or anything else going on in the market. So please reach out to us. And thanks again for listening in. See you for the next quarterly report call. Thanks.
This event has concluded. Thank you for using Inteller Event Services. You may now disconnect.